The stock market will never make you money if you don't understand it, because it does have the power to free you from your job, retire you at 30 years old, and provide for future generations. All of this is not possible if you don't understand the stock market. So in this video, I will be teaching you everything you need to know about the stock market to have financial success in it.
Is it Brian?
Hi, I'm Matt Janino. I teach you how to make money, grow money, and invest money. So please like this video and subscribe to my channel. I would greatly appreciate it. Why do you think millions of Americans put their money in their 401k? It's probably because their 401k is their best chance of retiring and, more importantly, getting paid when they retire. But also, a 401k is heavily invested in the stock market and the bond market. So the stock market is pretty much the only way millions of Americans can be free and quit their jobs. So let's forget about 401ks and try to understand the stock market, because here's a bold statement. Maybe the more you know about the stock market, the faster you can retire. I don't know if that's true or not, but what you should do is invest in yourself and watch this whole video as I dive into everything you need to know about the stock market. So let's dive into the real basics. What is the stock market and what is a stock? So the stock market is a place where investors can come anywhere around the world and buy and sell shares of companies. It's just a place where people that want to buy Apple can find people that want to sell Apple stock. Just like you go to this supermarket where if you want to buy bananas, you can find people that want to sell you bananas. And even in that supermarket, you can negotiate the price of what you're trying to buy. So just like you can negotiate and try to find the right price in the supermarket, you can do the same thing in the stock market. If you want to buy a certain stock at an exact price, you can wait till it gets down to that level, or maybe it never gets that cheap again. Maybe avocados are never 50 cents again in your lifetime. That could very well happen in the stock market and in the supermarket. Now let's dive into what a stock, how the price is decided on a stock too. And the cool thing is, when you go into the stock market and you buy a stock, you own a piece of that company, which entitles you to the profits and the losses that come with whatever happens to that company. Some companies, if you own a large enough percentage, they will put you on the board and you can have certain voting rights on that company and direct the future of it, which is pretty sweet. Some companies even pay out dividends to investors, so if you own a portion of that company, you can get paid a portion of the profits that are reaped from the sales. The whole concept is, if you're talking about Apple and you're buying their products, you're not really getting paid when you buy the products, but if you're buying their stock, you could get paid when people buy their products. So if you find the right company, you should be an investor, not a consumer, because the investors are the people that profit, and the only way to profit is to own stock with that company. Now let's dive into how to know what price to buy a stock at. What controls the price of a stock? And it is a ton of things. It is very hard for me to tell you if the stock you're buying is cheap or expensive right now. Just to list a couple of all the confusing factors that go into the price of the stock right now, it could be the current interest rates of the US government, it could be the revenue for the company, the expenses, the gross profit, the current dividend payout, the assets, the debt, the balance between those two. It also could be the CEO, the management. It could be the increases or decreases to dividends. All of that comes together in the price of a stock. But the core concept is boring stocks that have been around for a long time and have a great customer base are pretty effectively priced as cheap. But stocks that are new to the market, like IPOs, tech companies, those stocks are expensive. All that means is that you want to see the revenue numbers for that stock climbing quickly for those expensive stocks, or else your stock price is going to plummet. But for those cheap companies that have been around forever, their stock price really doesn't move much, and more importantly, they pay you consistent dividends throughout the year, and we'll talk about that later in that video. So I know stock price can be completely confusing, but what you want to understand is you're either investing in cheap companies or expensive companies, and the price you're paying is completely irrelevant unless you're looking at the underlying factors affecting the company, and if you really know how cheap and expensive it is at that moment. Just to reiterate again, if you find the company you're investing in is early and expensive, it has to grow at a relatively quick rate for the price to jump up on the stock or even stay flat, because If it does not, investors are going to jump ship and you're going to see that stock drop pretty quickly. Let's move on to the next part about the stock market. This is the brokers. And this word is just a place where you go to open up an account to trade stocks. And all a broker does is match you to buyers and sellers in the market. So if you think of eBay as a marketplace, eBay matches buyers and sellers. So we have sellers all the time selling products that they don't want or products they're trying to make money on. And what eBay does is match them to the correct buyers. And that's all brokers do. And a brokerage firm is just a bunch of people that are trying to match you to certain buyers or sellers. So when you get started in the stock market, it's very important you sign up with the correct broker. And we're in a wonderful time where you can completely trade the stock market or just invest in the stock market for free. Just signing up is free, and you can actually get free stocks for signing up, so make sure you click the links in my bio. The best brokers I use personally are Robinhood, Thinkorswim, and Webull. Thinkorswim is also called TD Ameritrade. It's very easy to sign up for these platforms. You can do it in less than 5 minutes, and all you have to do is deposit money in. Once you deposit money in, you can buy stocks. And the best thing is they're completely free, so they're matching you to buyers and sellers in the stock market, and it doesn't cost you a dime. So now let's get into some confusion you might find when you try to buy your first stock. So once you understand a stock, once you find one you like, and then you find a broker, a place where you can buy that stock, and you signed up, made an account, deposited your money, you're going to find this other confusing thing called an order type. So when you try to buy a stock, there's going to be a lot of buttons on the screen that can make the process really confusing and kind of turn people off from investing. So I just want to explain all the things you're going to be looking at and what you should be thinking. So when you try to buy a stock, there's going to be a couple order types. You have the limit order and then a market order. A limit order will lock you in at whatever price you want to buy that stock at. So if Apple's trading at $100 and I want to buy it at $100, it's going to look for sellers at $100. So I can exactly buy Apple at the exact price I put it in at with my order. Now let's look towards a market order. This is where you click market and then it doesn't have a price you can input. This is because when you buy certain shares at a market order, it's just going to line you up with the first sellers you can find. So if you want to buy 5 shares of Apple, and let's say 2 people are selling at $100 and then 3 people are selling at $105, you're going to buy 2 shares at $100 and then buy your next shares at $105 because it's always looking for the first sellers wherever they put their orders. Very crazy, right? So you can make huge mistakes doing market orders because you can get filled at prices you didn't want to buy that stock at. So it's very important to not click market unless you know what you're getting yourself into. And the same thing goes for selling orders. We have a couple more when it comes to this. We have the sell limit order, the stop loss order, and then the stop limit order. So 2 of those are for when you're losing money, and then 1 of them is for when you're making money. So when you buy a stock, let's say you bought Apple at $100, you want to sell it at $110, but you don't want to watch the market for the next week or the next year, you can do a sell limit order and it will actually sell your stocks at exactly $110 whenever the market gets there or whenever people put their buy orders there. So once we have matching buy orders, we can get filled at $110. So moving on to the selling orders where you're losing money and you want to make sure you don't lose more money. This is where you bought Apple at $100 and you say, hey, if my investment gets down to $95, I'm just going to get out because I don't want to hold something that will drop $5. This is for people that know their risk and know what they're willing to lose. So in this case, you want to put a stop limit order at 95 or a stop loss order at 95. And this works exactly the same as a limit and market order. If the stock of Apple moves from $100 to $90, 2 things are going to happen. You're not going to sell your order if you're at stop limit because it's only looking to sell exactly at that point. the $95 order you put in, it was only going to sell at 95. If the stock went from 100 to 90, it never hit 95. In that case, you never sold your stock. Now you lost $10 on this investment. Stop loss orders, this is where it sells it whenever it crosses the threshold of $95. So if it moved from 100 to $90, it would automatically fill at $90 because once it crossed 95, that's where the stop loss was triggered. So very minute differences, but you can use them for buying and selling in different ways. And it's very important to know what the limit and market orders are because you can lose a lot of money using the wrong order types. I just want to talk about one more quick thing. This is the spread. So when you're trying to put your order in as a limit order, you have to figure out what price you want to put it at. So there's going to be a buyer and seller range. This could be a whole $2. It could be $98 to $100 for Apple stock. So if you want to get filled as the buyer, what you should do is put it as close to the top of this spread as possible. So that $100, you want to put your order as close to that as possible to get filled. If you put it at $101, you will get filled automatically because you're above and beyond the spread. But if you put it at $98, the beginning of the spread, this is where all the buyers are. So if all the buyers are there, you're most likely not going to get filled because that's just not a place where sellers are, and it's just a place where overloaded buyers are. Now let's get into everything you could possibly buy in the stock market, all types of different investments, and most importantly, I'll let you know which ones might be best for you and the risks and the benefits associated with both of them. So we have IPOs first off. IPOs are the first induction of the stock into the stock market. We call this initial public offering. So let's say a company like Airbnb has been around for the last 5 years and you want to invest in this company. You cannot invest in Airbnb as of right now. This is October 2019, but this company is going public next year. So next year you could buy this company and be an investor because it's gonna IPO in 2020. But the scary thing with IPOs is that they are high risk, high reward because once they get launched, once the IPOs enter the market, the numbers with the company are just changing so much every quarter. The revenue goes up 100%, but they lose 3 times as much money. The revenue goes down 50%, but maybe the analyst thought it was going to go down worse, so maybe the stock pops. It's just very hard to understand what's happening with these companies. They're just completely random. So IPOs are just not companies that you want to invest in if you want safe returns and to protect your money. They're more riskier places that do have higher returns in the long run. Also very high chances of losing money. This is because in the first year that the IPO is on the market, the people that have been in the company the longest finally have a place to take profit and a place to sell their shares to someone because they're on the stock market, and if people want their stock, they can sell it to actual people now. And I'll tell you this, they have been waiting to sell their stock at a premium price for the last decade. So they're not going to wait around. They're going to sell the stock very quickly, and you're going to see IPOs drop 50% usually in the first couple months. So be very careful investing with IPOs. It's best to wait until the lockup period. This is that period where the insiders can start selling. Once the lockup period is over, once the insiders are done selling, that's the best place to pick up these stocks. Now let's dive into options. This is something I trade almost every day. Completely confusing, but this is something that you really have to take the time to understand before you dive in. Options are one of the easiest ways to lose 100% of your money and sometimes more if you're shorting them. All options are leveraged ways to trade certain stocks. And what leverage means is that with small amounts of money, you can control a large amount of shares of stock. So for $200, I might be able to control 100 shares of Apple stock. And right now, Apple stock is trading at $200. So I can control 1 share of Apple stock if I just bought the stock. But if I bought an option for it, I could control 100 of Apple stocks. So that means every penny it moves, I can make 100 times that. $1. Every dollar move, I can make $100 $5. That's a 50% return. A $2 move, I could make 100% return. For you to make 100% return just holding Apple stock, it could take 5 to 7 years. This is why options are so attractive, is because with the leverage, you can have insane returns. Now let's talk about the other type. This is futures. This is for traders mostly. Not many people invest in futures, but they're just like options. You have the leverage, but you don't have the time decay with it. So with futures, you're just not losing money every day like you do with options. So obviously there's some things I'm not explaining in the in-depth details on each certain type of asset, but it's very important for you to do your own research because there's a lot more I'm not talking about. This is just a general overview. So although futures do not have time decay that's happening each day, they do have an expiration where you have a contract and it kind of doesn't do anything after a certain point. That's where you have to scale out to the next contract. But now I'm going to get into some things that are a little bit more applicable to the first time investors. These are all the options that you can put in your 401k that are much better for long-term portfolios and not really for traders. So what I'm going to talk about now is mutual funds. So mutual funds were invented to beat these things called the index fund. And the index fund is just something that follows the overall market. It's just a basket of stocks that was chosen based off some criteria, and whatever stocks are in that criteria go in, and whatever stocks are not go out of it. So the criteria is just meant to understand what the general market is doing each year. So the returns of the index are what we call the benchmark returns. So if the index returns 7% per year, that is the benchmark of what every investor is trying to shoot for, because if you invest in the index, it is the easiest way to grow your money risk-free. So if you can't make 7%, you're not a good investor, because the dummy way of investing is just buying an index, and that's what most people do, and that's the easiest way to create wealth. But then some investors got together and they said, hey, I'm not content with 7%, and I'm actually a good investor. So what I'm going to do is put together my own basket of stocks and try to beat the index. And this is what plenty of investors do all over the world, and they actually do beat the index. So mutual funds are just actively traded index funds, I would say. They have a basket of stocks and they actively trade them, which allows them to beat the returns of the index. Many of the wealthiest people, the billionaires of the world, look towards mutual funds because they know people that have the skills that can beat 7% per year, can bring in 10, 20% per year. And every percentage you put in your portfolio per year can be football fields of difference when you retire. So two concepts I just talked about: index funds, just general basket of stocks. They're not actively managed. They don't have the best returns compared to some other investments, but they are safer. And then mutual funds, which were meant to beat the returns of the index. So if they don't, they're not a good mutual fund. These are actively managed, so they do charge a fee every year. You want to make sure that fee is pretty low. And then the third thing is the ETF. This is an exchange traded fund. And the problem with mutual funds is that you can't buy them during the day. You have to buy them when the market closes, because that's when the assets that they own are not moving, so they can actually calculate how much that mutual fund is worth right now. If the market's moving throughout the day, it's hard to know the actual price of the mutual fund. So now they created these other things called ETFs, and this was to solve that problem. So the net asset value, the NAV, for the mutual fund was very hard to calculate. So the ETFs are funds that are in real time calculating the price of all the assets they own and having people being able to trade them throughout the day. So you can hold these funds that can beat the index pretty easily, and most importantly, you can buy them during the day, sell them during the day. They're a little bit more liquid. And I haven't mentioned this word much, but when you're in the stock market and you want to find buyers or sellers, the ability to do that easily is called liquidity. And highly liquid assets just allows you to get in and out without losing a lot of money, because every time you're buying and selling a stock, you're going to trade that spread, and that spread can be wide. In my example earlier, I had $2 for the spread. So every time you're buying and selling a stock, you could be losing possibly $2 in just the spread. This is called slippage, and if a stock is more liquid, the spread is going to be smaller. So highly liquid stocks are going to be losing less every time you buy and sell. And the other investment type is bonds, which is greatly related to interest rates, which also is greatly related to how the stock market performs. So right now, bonds are at 3% yield, which is pretty much risk-free per year. So if you're in your 50s or 60s or 70s and you want money coming in every month, most people say 50% stock, 50% bonds. And right now, bonds will give you 3% per year, which is not great, but it's good enough. The reason this number, this interest rate on the bond is important is because if this is too high, let's say 7 or 10%, not many people are going to invest in the stock market, because if you can make 7% in a bond or 10% in a bond, the stock market only makes 7% per year on average. So if you can easily beat that in a bond, you will not put your money risking it in stocks that are jumping around every day. You wouldn't put your money in the stock market. Instead, you'll put your money in a bond, because that can be fixed rate and you can get paid for the next 10 years if you buy the correct bond. So interest rates just affect how the stock market goes up and the stock market goes down. It also affects how much corporations can borrow money. So low interest rate environments are great for corporations, and it's great for consumers because you don't have to pay that much interest when you get a car loan or student loans. Low interest rate environments are just good for growth in the overall economy, but if we stay low for too long, we really can't go lower in the next recession to bail ourselves out. So it's very important we have interest rates at a healthy level. So that's the last investment type. The next thing I'm going to go into is the charts. So when you're buying and selling stocks, you're going to notice every day the stock is actually tracked on a chart, and this is what we call candlesticks. So every day forms a candlestick on the chart, and that just shows you how the stock moved that day. The wicks of the candlestick can tell you something important, in the candlestick length as well as the body. So there's a lot of things that you can tell from a chart. And once trading charts were created, and once we got sophisticated enough to log every day on the computer, people were able to perform technical analysis, which allows everyday traders to understand where the market could be going and understand if it's weak or strong at the present moment, because they can chart certain patterns, they can chart certain momentum, they can put on indicators which tell us certain things. So there's a lot of cool things that can happen from just a stock chart. I look at stock charts every single day, and I give trades out to my trading group off what I see. I would say I'm a charting technical analysis master, maybe level 2 or level 3, and I've been doing this for a lot of years, and I had profitable trades just from looking at the chart. So it's really important you understand there's more to the chart than just the candlesticks and the overall direction of a 10-year movement. You can actually know when to get in and out, and when certain stocks are just not good investments without reading financial statements. So now let's talk about the goal of the stock market, what you're trying to do by investing in stocks, and how you can retire in your 30s. So the first goal of the stock market is to capitalize on that 7% per year, where your money just makes its own money, and eventually compound interest makes money on the money that it made previously, and it just snowballs year after year. So the more money you can put in every single year, the faster it's going to grow into an amount you didn't think was possible. This is all because every year on average you can make 7% in the stock market. Most importantly, you don't want to have your money in a bank account, because every year we have inflation at 3%, which is cutting down our buying power. So every time you're not growing your money 3%, you're losing 3% every single year. So it's very important you at least beat inflation some way or another with a 3% interest rate checking account, or maybe a bond that pays 3%. But the whole goal of investing, number one, is to beat inflation. And then number two is to capitalize on that 7% risk-free reward you can get from just investing in a low-cost index fund. And then goal number three is to save enough so when you retire, you can pay your bills with whatever you grew during your lifetime. And then the fourth trick in the stock market is you use the money that you grew, and when you're retired, you can buy dividend stocks. So if you have $1 million when you retire, you can find a bunch of dividend stocks paying 4% per year. So out of that $1 million, you can get paid $40,000 per year without reducing $1 million. The whole problem with investing in retirement is that you have to reduce the amount you have in your retirement account every year. This is the 4% rule. So if you reduce the amount you have in that account 4%, you can make it 30 years retired. But if you want to retire in your 30s or your 40s, you want to have 40 to 50 years of payments coming out of your retirement account. In that case, you cannot withdraw 4% per year. Instead, if you bought dividend stocks that paid 4% per year, then you wouldn't have to draw down on that principal. You could literally get paid $1 million till the end of time. And the best part is that investment of $1 million could actually double or triple because those dividend stocks can still appreciate if the companies do well in the next couple years. So this video I said was really everything you needed to know about the stock market, but there is so much more in the stock market. So make sure you check the link in the bio as I teach you in the course I created. And lastly, watch this video as I teach you how to buy a stock in simple steps. I just read an article that stated that 52% of people are not invested in the stock market. The stock market is free money, passive income over time. So if you could put your money away and have it work for you, why wouldn't you?